Well, let's consider how shareholder value moves forward in the economy through the 1980s and the 1990s. And there's a couple of things here that are worth noting that help to ease this idea into the corporate boardroom, making it a compelling framework for corporate governance. The first is that in the 1970s, we see the rise of the institutional investor. Regulatory changes allow for much more significant presence of institutional investing in the 1970s. An example of this would be the no-load mutual fund. Prior to the 1970s, if you bought a mutual fund, it was a loaded mutual fund. You had to pay a certain amount of cash to participate. And that had constrained their popularity, although I should note, there were certainly plenty of them out there in the 1960s. In the 1970s, we have the no-load mutual fund. You can trade it as a share. There's no price to entry. So we start to see the rise of mutual funds. In 1978, ERISA, the Employment Retirement Income Security Act, is passed. That allows pensions now to be invested in equity markets, which unlocks a whole bunch of capital that's out there driven through institutions to move into the market. It should be noted that prior to the 1970s, there were certainly institutional relationships with the firm. But where you found an institutional relationship with the firm was on the side of debt, bonds. And I'm going to make the argument that if you are an institution trading in a corporate bond, even if you have no intention to hold the coupon to term, even if you plan to sell it maybe 6 months or a year on, the very fact that it's a bond makes you think about the corporation's prospects in the long term, because the market value of that bond, when you go back to sell it 6 months hence, is going to be how the market assesses the likelihood of the firm's continued existence over the lifetime of the coupon. So prior to the 1960s, where we see these institutional relationships with firms, by the very nature of the instrument that they're investing in, locks in a kind of long-term framework. Starting in the 1970s, we start to see institutions then move on to the equity side of the equation and not just limited to the debt side, the fixed income side of the equation. There was one other important change that took place in the 1970s that helped to propel our story along. It goes by the rather unfortunate or complicated name of the Depository Institution Deregulation and Monetary Control Act. But that's just a fancy way of saying that banks, starting in the very late 1970s, were no longer regulated by the government in terms of the interest rate that they could offer their depositors. Prior to that, there was a fixed amount. You could say you can only get 5%, you can only get 4%, 6% in a savings account. They deregulated that market at the very end of the 1970s so that banks were free to offer their depositors whatever rate of return they wished. The consequences of this is familiar to us in what's known as the savings and loan crisis, because the institution that emerged to take advantage of that was the savings and loan banks that emerged in the 1980s, which seized upon the potential to offer investors higher than average returns to attract money, and then of course had to go out and make investments to justify those returns, and that's what helps to fuel the credit binge of the 1980s. And leads, of course, to the great S&L crisis at the end of the 1980s. One of the ways that that capital could generate above average returns was in the markets. And so we see in the 1980s the evolution of a credit instrument known as the junk bond. The junk bond is a below investment grade in a credit vehicle, which is used, or was used, by many on Wall Street to go up and buy firms that were trading below their book value, buy them up, break them into pieces, sell them off, and pocket the proceeds. This could generate significant returns, and so it became an attractive vehicle for many of these S&L companies, along with real estate, looking to secure above average returns so that they could pass those on to their investors and accumulate capital. Well, in the context of the market, in the context of a firm that has a relationship with the public marketplace, this phenomenon in the 1980s of people going around using cheap access to credit to buy up companies, break them up into pieces, sell them off, and pocket the proceeds, was a strong incentive to adopt defensive measures to prevent that from happening to you. Some of you will know the famous story about R.J.R. Reynolds, the Barbarians at the Gate, and so on. Some of you will have seen the movie Wall Street about Gordon Gekko. That was his job. This was known as green mailing. There are some boutique firms out there today, KKR, that started in the 1980s as famous green mailers. What's the most effective way for a firm to protect itself against green mailing? And the most effective way to protect yourself is raise your share price. If you can simply raise the cost of acquisition to the point where you are no longer a compelling takeover target, that's the best defensive measure that you can adopt. It's not easy simply to raise your share price. You can't just snap your fingers and say, I want a higher share price. You have to convince the market under our efficient capital market hypothesis. You have to signal to the market information about who you are, what you're doing, and so on, so that the market will then, based on its review of your future earnings, raise your share price. And so what we find is that in the 1980s, many firms are incentivized to embark upon strategies that give the market exactly those signals as a way to avoid this kind of peril. In a way, we might think of the greenmailing of the 1980s as a sort of picking off the low-hanging fruit in the market and incentivizing firms to adopt strategies that would drive value into their share price as a defensive posture against this kind of idea.